Let me ask you something. Is your investment strategy starting to feel more like a lottery ticket than an actual financial plan? I mean, in a world just full of noise, AI stock picks, crypto gurus, you name it, it's so easy to get sucked into the hype. But what if the real secret to long-term success was way simpler than you think? So today, we're going to cut through all that chaos and explore a time-tested strategy that really works. Let's get right into it.
You've heard this a million times, right? The casino always wins. It's the perfect place to start because it sets up this really powerful analogy for the world of investing, an analogy that might be a little misleading.
And here's where we need to see the difference. In a casino, yeah, the math is literally built so you lose over time. The stock market can feel the same way because you're not just playing, you're up against these massive institutions with trillions of dollars. It can feel totally rigged. But here's the good news. Unlike a casino, there are proven strategies you can use to dramatically, and I mean dramatically, increase your odds of winning.
Ready to crack the code? Okay, here's our game plan for today. We're going to start with the market's own casino rule. Then we'll dive into the emotional investing trap that snares so many people. After that, we'll get into the good stuff. Bogle's brilliant portfolio, how to make risk actually work for you, and what the real secret to winning is. Let's do this.
First up, the market's casino rule. It sounds a little backward, but to become a great investor, you first have to understand what not to do. So we're going to start by looking at the really common, really painful mistakes that so many people make. Their missteps are actually going to be some of our most valuable lessons. So let's meet a character you probably recognize, the emotional investor. This is the person who lets their feelings, fear, greed, hype, drive their financial decisions instead of logic. And as you're about to see, that is an absolute recipe for disaster. We all know someone like this, don't we? They hear a hot tip, they download some flashy trading app, and boom, they throw their life savings into the market without even thinking twice. It's this all-or-nothing, impulsive move that's the first step down a really dangerous road. So what's their strategy? And I'm using huge air quotes there. They dump half their money into some random penny stock they heard about on an internet forum. Let's just be super clear, this isn't investing, this is gambling. Plain and simple.
And for diversification, they pour the rest into a tech stock that's already shot up like a rocket. Again, this isn't a strategy. It's a classic case of chasing the hype, buying at the absolute peak, and just hoping to catch a ride on a rocket ship that's already left the launch pad.
And this emotional roller coaster, it pretty much always ends in one of two ways. One, they lose big, and then they lose the rest trying to desperately win it all back. Or two, and this one is almost worse, they get super lucky one time, think they're some kind of genius, and then lose everything trying to do it again. Either way, it ends badly. To really get how much of this is pure luck, just think about a roulette wheel. The odds of hitting a green slot in American roulette are a tiny, tiny 2.6%. I mean, that is a serious long shot. Now imagine you put 10 grand on that tiny 2.6% chance and you win. You walk away with $350,000. Does that make you a gambling genius? Of course not. It just makes you incredibly lucky. But this is exactly how people see a big win on a speculative stock. They think it's skill, when really, it was just a random stroke of luck. Okay, so how do you avoid this whole emotional trap? Well, the answer is in the simple but incredibly powerful strategy from the legend himself, John Bogle, the founder of Vanguard. His whole approach is about working with the market, not trying to be smarter than it. And here is the absolute beauty of Bogle's strategy. It is so simple. It's just three things: a US market index fund, an international market index fund, and a bond index fund. That's it. No more chasing hot stocks, no more hunting for penny stock miracles, just simple, broad, diversified ownership of the entire global economy. And adopting this approach is a total game changer. You stop chasing the best investment, which, let's be honest, is impossible to predict anyway, and instead, you focus on building an optimal portfolio, one that's smart and statistically reliable. It's about playing the long game with the best possible odds, not trying to hit a home run every single time. But wait, what about risk? Index funds aren't risk-free, and that's true. But here's the key: it's a calculated risk. Over the long haul, the market has historically rewarded investors who are willing to ride out the ups and downs. That is exactly what we mean by compensated risk.
Think of it like this. Your portfolio will have good years and it'll have bad years. That's a given. But the long-term trend, the average of all those possibilities, is upward. By just staying invested through all that volatility, you are essentially getting paid, in the form of growth, to take on that uncertainty.
It's a really powerful idea that can completely change how you see investing.
And this chart just tells the whole story. Look, cash might feel safe, but inflation is this silent killer of wealth, just eating away at what your money can buy. Bonds give you a little boost, but historically, stocks are where the real growth happens. We're talking average annual returns of around 8 to 10%. A total market fund is your ticket to capturing that wealth creation.
All right, now for the most surprising secret to long-term success in the market. It's not about the brilliant moves you make, it's about all the dumb things you don't do. Seriously, just avoiding the common mistakes is way more important than trying to be a genius.
You know, it's so easy to get distracted by the latest fad, the temptation of some secret ETF, a hot new trend like AI, or some fund manager promising the world. It's all just noise. These are usually just expensive distractions. The real work is just staying disciplined and sticking to your plan.
And this quote just hits the nail on the head. Look, anyone can get lucky and have a good year, but consistently beating the market for your entire investing life, that's nearly impossible. Very, very few people ever achieve it. And that's exactly why a simple, boring, diversified approach is so powerful. So what's the ultimate key to success? What's the secret ingredient? It's a strategy that is both incredibly simple and profoundly effective, even if it's a little boring sometimes. And that is the power of patience. The discipline to just wait is the true foundation of building long-term wealth.
And the difference between these two paths is just so stark. You've got the day trader on a constant, stressful roller coaster of wins and losses that usually just ends in a crash. But the patient investor, they're on a slow, steady climb. It's not always easy to stick with it when things are down, but the long-term rewards are absolutely worth it.
So as we wrap up, I'll just leave you with this one thought. Which path will you choose? Are you going to play the frantic, high-stakes game of the emotional trader, or take the calm, steady, and proven journey of the patient investor? The choice is yours, but I really hope this explainer has given you the tools to make a great one.